let us cover Disney's earnings. Because, as I just said, they just came out today, and it's a major company. So let's see what we can actually learn in regards to the earnings for quite possibly one of the biggest IPs on the planet here, Disney. So let's get started with this. Now, if we come over here, guys, to Disney's earnings, we can see that on the 10th, they were expecting an EPS of 94 cents. On a non-GAAP basis. On the GAAP basis, 72 cents. Look at this revenue estimate, $21.8 billion. This was look at this. 19 analysts, 19 revisions to the downside. That's insane. That's absolutely insane. So let's take a look at if we got, here we go. So, oh my God. Disney non-GAAP EPS of 93 cents misses by a penny. Revenue of $21.82 billion in line. And they fell a massive amount because of the fact that they just missed by 1 penny. Look at this, guys. Post-market, Disney, 4.5% down. That's crazy. And even on the intraday, they fell 1.02%.
And they gave mixed guidance.
Did they give mixed guidance?
Yeah, so that's basically just pulling it up on earnings whisper. The guidance was mixed. Okay. So there's some good and bad points about it. Got you. So it results in reaction. Got you.
So let's speaking of the guidance, let's actually move into the actual earnings report, because just because it misses on what some stupid person says doesn't mean that they're not growing year over year. So let's take a look at this, guys. We got Walt Disney Company report second quarter and 6 months earnings for fiscal 2023. We got the Walt Disney Company to report their earnings for the second quarter ended in April 1st. Revenues for the quarter and the 6 months grew 13% and 10%. There you go. That's exactly what I mean. Revenues for the quarter and 6 months grew 13 and 10% respectively. Diluted earnings per share EPS from continuing operations for the quarter increased 69 cents from 26 cents in the prior year quarter. All right. So basically, Q2 of 2022, it was 26 cents, and now it increased to now 69 cents. Okay. Excluding certain.
Roughly.
What was that?
Roughly, yeah.
Excluding certain items, diluted EPS for the quarter decreased 93 cents from $1.08 in the prior year. Okay, so that right there, the diluted EPS, that went down, right? That went down. EPS from the continuing operations for the 6 month ended April 1st increased to $1.39 from the 89 cents. This is like all over the place. This is definitely mixed. Excluding certain items, diluted EPS for the 6 months ended April 1st decreased to $1.91 from $2.14 from the prior year period. So yeah, it's a lot of ups and downs when it comes to this. Sometimes it misses, sometimes it beats. So, okay. We are now going into the CEO's comments. We're pleased with our accomplishments this quarter, including the improved financial performance of our streaming business, which reflects the strategic changes we've been making throughout the company to realign Disney for sustained growth and success, said Robert A. Iger, Chief Executive Officer. The Walt Disney Company, the Walt Disney. Okay, got you. From movies to television to sports and news and our theme parks, we continue to deliver for consumers while establishing a more efficient, coordinated, and streamlined approach to our operations. So nice, short, and sweet. Let's compare some of these numbers, guys. We got over here the revenues. April 2nd, 2022 compared to April 1st, 2023. Look at that jump. This is what I'm talking about. Just because they missed on, just because they missed on analyst estimates, guys, look at that jump: 19.25 billion to 21.8 billion on revenue alone. That's a change of 13%. And then on the 6 months ended, 41.1 to 45. That's a 10% increase, as we saw up there. Income from continuing operations after taxes, that went up 93%. Absolutely crazy. Free cash flow, I'm actually going to skip down a little bit over here because most of these is just like diluted earnings per share and that kind of stuff. But we got over here cash provided by continuing operations, 1.765 billion up to 3.23 billion dollars. In fact, 3.24 billion dollars. That is a massive increase of 83%. Okay, 83%. That's huge. Free cash flow. Look at this, Mike. Look at that free cash flow. From 1 year, more than 100%, $686 million to $2 billion in just 1 year. Absolutely crazy. Now, the 6 month ended, you know, okay, on the 6-month ended, unfortunately, it's in the negative, but negative 504 to a negative 168, it is still an increase of 67%. So, okay, it's right there. It's all right, I guess you could say, but still though, right there on that quarter over quarter, or at least, sorry, on the quarter ended April 2nd, 2022 to April 1st, 2023, that is a massive jump. It's absolutely insane. And here we go into like the specific segments. I'm curious to see, I wonder, this is the segment of results, but which segment are we talking about here? Well, actually, segment reviews. So we got Disney Media and Entertainment Distributions, $13.62 to $14 billion. Disney theme parks, look at this. Disney Parks, Experience and Products, 6.6 to now 7.7. So everything went up by around like $1 billion or so. Total
even segments, with all the political upheaval, as I'll say, all the controversy that's around Disney and its self-governance, it's still making more money. So that's pretty impressive.
Yeah, let me actually pull that up because I'm not really going to get into that, but it is important when it comes to investing, guys. You really want to be, so Florida versus Disney. So for anyone of you guys who doesn't know, let me see if I could find something over here. Let's see. So for anybody who doesn't know, guys, Ron DeSantis of Florida, the governor of Florida, is getting into a political fight with Disney, saying that, like, if we're going to strip away this, we're going to strip away that. You guys have, because for anybody who doesn't know, Disney, it's its own, I guess, governing body in the state of Florida.
Little country, in a sense.
Right, yeah.
It's like, think of an island, like in a country that's an island. Think of that as Disney.
So they literally have like their own police. They have like their own laws. They have like their own everything. And right now, the governor is pretty much going at it like, no, we're going to strip that away from you. The reasons for it, not really that important, but understand that that is a thing that's happening, right? That is a thing that's happening, and that might affect a lot of our investments. Because let's face it, if it didn't, then first of all, it wouldn't be on the news. And number two, this is strictly affecting the parks, right? Mainly Disney World. Now, I normally would be like, whatever, it's only one segment. Except, guys, what happened just a few years ago that shut down the parks, that dropped all of their revenues down pretty much near zero, right? What was that, Mike? COVID. So the fact of the matter is that I'm not saying that this is going to happen, but imagine, again, hypothetical, probably not going to happen, probably won't happen. Disney's way too big for that, and I think there will be massive revolt if it were to happen. But if the state of Florida says no more Disney World, shuts it down, what do you think that's going? It's going to have the exact same effects as COVID did. To have the exact same effects as COVID did. In fact, it'll actually be worse because it'll be like no chance that it'll come back. At least with COVID, people were like, it'll eventually go away, right?
Yeah, and also people like it's, and the thing is, like, take all the politics out of it.
Right.
It's more the perception of Disney is going to spend money to fight that. Yep. Therefore, they're not going to be able to make as much money for me, the shareholder. Yep. So therefore, my investment is going, and the perception of my investment is going to be lessened.
Pretty much the 7.7 or 7.78 billion dollars would essentially evaporate. I'm not saying that that's going to happen. I'm just saying that, worst case scenario. So
yeah, you were saying, and the market prices in the future now. So if they perceive it, they're going to price it in now.
Right.
And then when it doesn't happen, that's when you get the rip up.
That's when you get the rip up, right? And so that was in regards to the revenue. In regards to the income, you can see that it actually went down. Look at this. Well, it went down in regards to the Disney Media and Entertainment, so Disney Plus. Almost $2 billion, down to $1.1 billion, guys. That is a decrease of 42%. That's surprising, because you would think that Disney Plus, I would argue Disney Plus is the one thing that's keeping Disney alive, right?
Well, it could be like, and now not getting into politics, they have been leaning more towards certain political issues, and maybe people are just basically saying, hey, I watch TV because I want to get away from stuff, not to be fed it. So, and maybe they're having a bad reaction to it.
So here's an even simpler thing than that. You ready? Maybe they're just like, we've seen everything.
Fair. They're not getting creative. Right? They're not innovating.
Like maybe they're just like, how much can you watch a Snow White before you start getting bored?
Yeah.
Right. Like that's my point. And if
on
people,
here's another factor: inflation. Are you going to pick to put food on your table or watch Disney?
That's always, absolutely always. You watch Disney, you don't need to have food. I'm just joking, by the way. No, but yeah, I absolutely agree. And also, Disney Plus is by far one of the most expensive ones. Like the series I have with my wife, where she's investing to essentially get passive income, so that way she can pay, or the dividends can pay for her streaming services. Disney is the highest one. Disney is the highest one at $9.99. Now that's Disney and Hulu Plus. Or sorry, Disney and Hulu, not Hulu, but
does Disney own Hulu?
Oh yeah, Disney owns Hulu, ESPN, and one other one. But out of all of them, Disney is by far the most expensive one of all of them. In fact, I can even pull it up just to show you. But guys, that is pretty much like when it comes to this. Now, something else that I really am curious about is the fact that, domestic channels revenues for the quarter decreased 4% to 5. Okay, so something else, guys. Disney, I believe, last quarter announced that they were going to reinstate that dividend back. So I wonder if they have said anything about this, because Disney used to pay an annual dividend, but they no longer do that. So mainly because of COVID, right? It actually happened because of COVID. But I wonder if
or was that the part of their mixed guidance where they said they were negged on that?
Actually, you're right. Let's take a look at guidance. Let's look up guidance. And there is no guidance. All right, great, awesome, absolutely love it. Yeah, I don't know why there isn't any guidance though. What's it? What would be another synonym for guidance?
Forecast.
Forecast. Forecast. No, there's no forecast either. I mean, it would be up here though. It would be like right here. It wouldn't.
But whatever it is, it's like you can tell shareholders whatever, unless the fundamentals line up, it don't make sense at all. So
yeah. But see, okay, here you go. Disney Plus, you got ESPN, you got Hulu, so yeah.
What's with Disney just making political decisions with their streaming services? Well, like you had ESPN before, now Disney. It's like, come on, guys, just stay out of it.
Here, this is mainly just for you, but you can see here Disney Plus and Hulu is $9.99. It's the highest one. So
gotcha.
Yeah. So yeah. All right. So with that said, guys, let's actually, I don't think they said anything about the dividends. So it is what it is. When anything happens with that, I'll keep you all updated. But let's jump into now, guys, the calculator, because Mike, I showed you this before we started.
Yeah, it's crap. It's absolute crap.
It's surprising. I wouldn't say crap. It's surprising because this is not something that you would expect from Disney out of all companies.
A company that has 100-year bonds on itself.
Right. So we got the ticker, guys, for DIS, market cap of $184.76 billion and a PE of 55.64 with a current share price of $101.14. Now, this PE is the biggest red flag on the planet right here. 55? Guys, I like to buy anything under 20. 55! This thing is, I mean, come on. I just don't know what else to say about this.
And the technical piece don't get better, guys. Fair warning.
Fair warning, great. Guys, as I showed you all, when it came to Disney, when it came to Disney, well, they're down in the 1 year, 5.11%. Year to date, they're up 13.7%. 52-week range is $84.07 to $126.48. Looking at this when it hit COVID, guys, we are at COVID, well, we're not at COVID lows, but we are, like, the graph didn't move. Like, from here, actually, I wouldn't even argue, from the 5-year point.
You're near COVID lows.
Well, no, look at this from 2018.
Oh,
104.
Wow. Sideways.
104. It's sideways. Like, the entire graph is sideways. It's gone nowhere. Now, bro, even on the 10-year, it hasn't even gone, well, I guess it's gone up a little bit.
So basically, you're going back to 2015 levels.
I would argue, yeah.
Almost a decade.
2015 levels,
almost a lost decade.
Almost a lost decade. And again, guys, today alone, intraday, down 1.02%. Aftermarket, 4.55% down. Current price of $96.54. So This is interesting. This is interesting to say the least. Now, they don't pay out a dividend. They used to, not anymore. In fact, we can actually take a look at this dividend if we so wish to do so. We can take a look at the history, and we can see that if we go to the max, they paid it, on an annual basis. Only one time. But actually, they cut it in 24. Look at that. They actually ended up cutting it. Interesting. I didn't know that. And then fully suspended it. Oh, no, they didn't cut it. They went from an annual to a semi-annual. Look at that. Okay, that's interesting. Okay, so that wasn't a cut. It was just they went from annual to semi-annual. And then, shock. Well, the last time they paid it was on December 12th, 2019, because we all know what happened that March of 2020. They cut it. And, well, when we take a look at their fundamentals, you guys are going to see a massive drop when it comes to that 3-year-ago value. So this dividend is non-existent. They did say that they are going to reinstate it back, but I don't really know when that's going to happen. We'll see. Now, here's what caught me by surprise. Look at that free cash flow. Remember, this is not taking into account the subtraction of the dividend because there is no dividend. The 5-year average, 3.6 billion. Okay, great. The last year's 1.1 billion.
It's just shriveling. Is significantly decreasing.
It's significantly decreasing. So, with that said, let's delve into these fundamentals, shall we? Now, we got the net income. Okay? We got the net income 5 years ago of 12.6 billion to 1 year ago of $3.15 billion. That is a decrease of 75%. So, I mean, the big outlier here is 3 year ago, right? But COVID related. And ever since then, they did bring it up. So, what do you think about this graph?
I think it's pretty well, COVID, but here's the thing, you're already decreasing into COVID.
Exactly.
So, and you haven't, COVID affects you for 2 years, but now you should basically be, okay, we're back to the 11, that's in billions. That would be a billion, right?
Yes, this is billions.
So you should be up like 8 billion, right?
And also not to mention, go on, sorry.
You shouldn't be at 3. So it's plain and simple.
And also not to mention, again, not trying to bring politics into this, but Florida was one of the first states to be like, we're done with the restrictions.
So you're asking Disney, what's your excuse, basically?
Right. Exactly. What's your excuse? Right. So,
and to me, the graph is like a 35 or a 40, just because you have nothing that's statistically outlawed. Like, COVID is COVID, right?
Right.
But to your point, Florida was one of the first states to reopen. So therefore, Disney had an advantage over its competitors to then.
Maybe not
honestly,
Disneyland.
It makes the grade even worse because they're not taking advantage of it.
So maybe not Disneyland, that's in California, but we're strictly talking about Disney World, which is the main one, right? That's the main one.
Here's the thing: if everyone's cooped up inside, shouldn't they be making more profits
through Disney Plus? Less? Through Disney Plus,
yeah, to offset their revenues. So let's say it doesn't total.
Yeah, but I think. Hang on a minute. When did Disney Plus come out? I think it was 2020. I honestly think it was 2020. Hang on.
But Hulu was a thing before. Hulu's been around for a bit.
But I don't think they owned it then. When did Disney Plus come out? Let's see. November 12th, 2019. So it was in its infancy. It was in its infancy by COVID. By the way, I'm hearing my echo again. It was in its infancy by COVID. But I would argue, okay, it was in its infancy, but the fact that it was in its infancy, that means that not a lot of people already had watched the shows. So
it was something new.
Right, they had something new or nostalgic to watch. So you said what, 35 to 40?
I was gonna say 30 because it's like you had all these factors that were pushing for it, and it's like you're not taking advantage of it.
Right. Okay, looking now at the free cash flow. This is the one, by the way, that caught me off guard. And unfortunately, guys, this is the one that's, well, when you guys see the calculator, you're going to be like, what? That has to be wrong. And then I'm going to show you 2 other metrics that kind of make my case. Huh?
That kind of sway it in your favor.
Kind of, but not really. Guys, look at this free cash flow. 5 years ago of $9.8 billion to 1 year ago of $1 billion. It was higher during COVID.
Yep.
It's higher during COVID. Now, guys, remember, free cash flow, it is cash from operations less your capital expenditures. And if we take a look at this. So here we have the cash from operations. Look how much they did in 2018. $14.3 billion. And you can see that their capital expenditures was $4.465 billion. Their cash from operations hasn't been fluctuating that much. Don't get me wrong, it has gone up, it has come down, but it really hasn't on the grand scheme of things. You get me? So look at this cash from operations though. Look at that, 14.3 to 6.61 to 7 to 5.57 to 6. This is going nowhere. This right here from 2019 prior to COVID to 2022, I would even argue even trailing 12 months because they end their year in October. So, it's pretty much not going anywhere, which is very concerning. Yep. Very concerning. So where is this cash from operations coming from? I don't know. And that's the thing too. If the cash from operations was coming down, but so was their capital expenditures, I would be like, okay, I guess. But their CapEx is the same.
You can make the argument for COVID, right? Like because they're having to pay for property, they're having to pay for all this.
Sure.
But then again, it's like, how long are you guys going to use COVID as an excuse for something?
Right. Especially with Disney Plus, right? And the
you
fact
you would think everyone would be like, that's the one thing people would latch onto.
Right.
That it wouldn't be the thing that people like push away first.
Yeah. I fully agree. So that is that, guys. We can see that this is a downturn of 89%. Hang on a minute. 89% down on the 5-year, and the average it is $3.642 billion. What would you give this as a grade?
Same as before, 30. That's just absolute. Like
I would give it less though. That's me. That's me. Because look at this. This thing went from $9 billion down to $1 billion, and then
the reason I would argue it wouldn't be lower is because I would like to see, like, if we had the Seeking Alpha like extension where we could see the 6, the 7.
That's fair.
What happened that year before? Because if you take it out and let's say it's a statistical outlier, then the slope normalizes a little bit. Yep. But regardless, it's still crap. It's still a negative decreasing slope, even if you do it for the years 4 to 1. And it just, there's not a lot of...
we don't have enough data for this. Honestly, like I would really like it if we were to get the other what? Let's see. How many years is that? How many years is that actually? Let's see. We got 1, 2, 3, 4, 5. So the last 5 years. So pretty much the last 10 years.
Yeah.
So 30%. I'll take that. Looking now at the revenue. Look at this.
Which is even more baffling.
Right. We got 5 years ago of $59.4 billion to 1 year ago of $82.7 billion, increase of 39.2%. What do you think about this? I mean,
I like it. It's an increase. It's going up. You got some ebbs and flows in it, like you're naturally going to have.
Well, no. Hang on a minute. These two is from COVID.
That even makes the previous 2 graphs even worse.
It makes it weird. This is
I'll take that. It makes it weird. It doesn't make it.
This is one that I would argue, guys, you definitely have to do your own research on this because I'm not investing in Disney anytime soon. I don't care for them like at all. But this is just weird. Like, why is their revenue consistently going up, yet their free cash flow is coming down, even on the 1 year ago, right? And their net income is okay. It's coming up, but it's not as high as it was over here when it came to 4 years ago. So this is all over the place. Great.
I like it because if I look, like you always tell me, look at the chart. I would basically say like a 90 or a 95 because there's a constant increase.
Yep. I would argue 95, honestly. I'll go with 95. Because if you exclude these 2 outlier years, because it was COVID.
And it's COVID, right? So it adds to it.
So, yeah, I would say 95 as well. Look at this. Assets minus liabilities now. Pretty consistent increase overall. Once again.
And almost like, and if you take the 5-year out, that's skewing the data, it gets really nice.
And again, you see the dip 3 and 2 years ago, but even from 3 to 2 years ago, it recovered and pretty much recovered to near what 4 year ago was.
Yep.
So average total assets,
95.
hang on. Average total assets is $201 billion. Average liabilities is 97. Look at this assets minus liabilities, though. $104 billion. That's massive. So you said what? 97?
95.
95? Okay. All right.
Yeah, just to keep it consistent.
All right. Yeah. No problem. Cash flow minus the liabilities. Now, we did see that their cash flow consistently decreasing. Yet, look at this. Their worst year was COVID at negative $100 billion. Now, prior to that, they were going down. But after COVID, then they started to go up. Even though their free cash flow is still going down. So this means that they're definitely lowering their liabilities a significant amount. Seeing that as of 1 year ago, it's not lower than the average at negative $83.65 billion. But it is a pretty big jump going from $99.4 billion to $94.2 billion. So what would you give this as a grade?
I'm torn, so I'm going to say 50.
Okay,
because fair. If you take the 5 year out, the average gets better.
It does.
And and it's COVID, so it's like I don't know.
Well, no. If you take off the 5 year, the average gets worse. These are negatives.
The average gets worse, but the current value to average range is better.
I don't think
because
so.
The average will come down, but the 94,
but the 5 year ago value is bringing the average up.
Yeah, okay. I see your point.
These are negative numbers, my dude.
Yeah.
So the closer you get to zero, the better it is.
Yeah, I'm thinking like just how close the delta is between the average and the current number.
Right. Yeah.
But even it's you're torn. Like you're straight out torn because it's like you see good and you see bad.
Yeah. I would me personally, I would give it like a 55, maybe a 60, just because I'm like, let's see where they're going with this over here. Right.
But you also always argue that you want to see a company prove it rather than assuming it.
Right. But that's why I would give them like a 55 or 60.
Okay.
I'm giving you the benefit of the doubt, but not really much. Now, shares outstanding. This caught me by surprise. Because this is insane, guys. We got 5 years ago of 1.5 billion shares to today of 1.83 billion shares. That is an increase in the 5 year of 22.72%. And 0.11% from the previous year to the current year. This is looking at, 1 year ago at 1.824 billion to 1.826 billion. So you can see here, the big jump happened 5 to 4. So not even during COVID. That's already a red flag. Why? Right? Why did that happen? Maybe they wanted to issue shares because maybe they thought that actually, what was their share price 4 years ago? Right? That's the question.
I can pull it up.
Okay, pull that up. Because one of the reasons why could be, hey, we just want to issue shares because we feel that our share price is really, really high. B, acquisition, right? Or C, maybe they just wanted to do to raise capital one way or another.
They're about where they are now, 115.
Yeah, but in comparison to valuation, though, right? In comparison to actual valuation, because you got to think about that. Right? Because like, I mean, right now the PE is 55. I would argue, in fact, I am going to argue that it's expensive right now. So for all we know, they may feel the same. They may be like, our company shouldn't be worth, whatever. Our company shouldn't be worth $96. So what would you give this as a grade? It's consistently increasing too. You can clearly see that right there.
Yeah. Like 30, 35, because it's. I don't like the jump, but I can kind of.
The jump was only 1 year. The jump was only 1 year.
Yeah, it's already priced in. So, but I don't like that it's consistently increasing. So maybe like a 40, just because it's not too terrible, but it's not something I want to see.
Okay, 40.
Yep.
Okay. We got the 40% right there. And lastly, when it comes to the cash equivalents, they currently hold $8.47 billion, an average of $10.6 billion. Now, looking at the overall grades, guys, net income of 30%, free cash flow 30%, revenue 95%, assets minus liabilities 95%, cash flow minus liabilities 50%, shares outstanding of 40%, overall grade of 53. What do you see the problems here?
Mainly free cash flow and income.
Yeah, 100%. And once you fix that free cash flow, you're going to fix this cash flow minus liabilities. I would argue also the shares outstanding. They're diluting you. They're diluting you at a pretty good rate, right?
Yep.
So 53%, guys, is actually surprising. It's actually very, very surprising to say the least. Now, here's where the controversy is about to start. What price should we pay for this company? Guys, every investment is the present value of all future cash flow. And this free cash flow isn't good. This free cash flow is not good at all. I have hopes that they'll bring it back up. However, as I say, they need to prove it. They need to prove it. They could say all things, how they're going to, colonize Mars, and they're going to introduce Mars Disney or whatever, right? But at the end of the day, guys, they need to prove it. So let's make some assumptions here. Now, before we make any assumptions, again, no hate, right? I'm going to show you guys exactly why this is happening this way. But guys, not adjusting for, well, not inputting anything. With just a required rate of return of 10%, guys, this is a target price of $4.15. What do you think about that?
Well, if I didn't see the technical piece of it, I'd be thinking it may be wrong just because Disney can't go to that. But when I see what I refer to as and we'll get into this technical piece. There's something I always talk about when I look at certain companies, what people request. And I basically tell you, if you're below this, run the hell away. Run away, run away, run away. Mm-hmm. And Disney has that characteristic. So,
okay. So, yeah, this is rather interesting. Now, adjusting for debt, this comes into the negative, and I am just double checking this just to be on the safe side. But the reason why it's in the negative, guys, is because they have a lot more debt than they do cash on hand. So that's the reason why. Their current net debt, it is almost $40 billion in debt. So that's the reason why. And just to make sure I got that correct, yeah, right there, $40 billion in debt. So that is correct as well. So we can pretty much ignore the after debt one, right? We can pretty much ignore the after debt one. But, okay, Mike, tell me what you want for the revenue and the predicted share buyback. Now, looking at
revenue growth.
So Seeking Alpha is estimated forward at, this is Disney, right? 12.55. Look at the earnings. 13%. Interesting, right? So,
yeah. So let's do low ball 8.
Okay.
Let's do what they did now, 12.
13.
Yeah, well, do 12 just to make it a round number.
Okay.
And then we'll add 4, that's 16.
Okay. Okay, 16%. And for the predicted, what was that?
As a stretch goal.
Right. And the predicted share buyback?
So they were issuing by 0.1%. So basically, let's say issuing half.
Well, remember this is the next. Yeah, but remember this is the next several years.
Yeah, but it's 5-year assumptions, and they're issuing 0.1% per year.
Right.
So you get about.
So 0.1 times 5. You get me?
Yeah, 0.5. So 0.5%. Do that for the median, 0.5%, 1% for
issuing or buyback.
Issuing for low, issuing 1%, and then 0.5% for median, and then 0 for high. I don't think they're going to buy back shares.
So -1, -0.5, and 0.
Yep.
Okay, guys. With this, we got the target share prices of. It almost doesn't even look real. Like I look at this and I'm just like, this. I don't think this is right. I'm sorry. I even have like just weird thoughts about this. This is just weird. $5.43 to $7.13, guys. I mean, I don't know. I really don't know. So usually when this happens, I like to go to my next best thing, which would be the book value per share. And we got over here the tangible book value and the book value per share. So this is taking the assets minus the liabilities divided by the current shares outstanding. And based on the book value, this company should be worth $52.66. So, okay. Looking at the tangible book value, $2.15. So this is what I'm talking about, that I have no idea where to value this company. I'll admit it. I'll admit it. You know, I am one of those people that you ask me to evaluate a company, and if I don't know, I'm gonna be like, throw my hands up in the air, like I just don't care, and then I'm gonna say, I don't know. That's just that. I don't know. I'm perfectly fine with saying I don't know, because the calculator is telling me around $7, $6. Book value is telling me 50, which kind of makes sense, right? 52 makes sense, seeing that the PE is 55, and if I like to buy under 20, you know, that drop, the current share price is $100, right? Going from 100 to 50, that's a drop of 50%. Therefore, it's, yeah, that's the PE being 55. It makes sense dropping to 20. I kind of see that. But at the same time, the tangible book value is telling me $2.15, which is matching the calculator. So I don't know.
Well, maybe the technicals can show you a little insight.
Maybe technicals could do that. So that's pretty much, guys, when it comes to the discounted free cash flow part of it and the fundamentals. Please, guys, all of these, I will also have the link for the Disney earnings are in the description below on the live stream, and they'll also be in the video as well. Guys, all of these calculators are available for free. Please use them. Make your own assumptions. Please read not just their earnings, but their 10Ks as well if you want to invest into a company. Please. Because the last thing we want is for you guys to lose your hard-earned money on something like a Peloton. So we don't want that. Make your own financial choices, guys. What was that?
Funny you bring up Peloton.
Okay.
They actually beat earnings twice in a row now, which...
Great.
So they may be turning that sinking ship around.
Well, they did hire somebody to do that, but that's a separate thing. Guys, make your own decisions. This is not financial advice. This isn't even due diligence, right? This is not even due diligence. So make sure you make your own financial decisions. The earnings will be linked in the description below. You use the calculators. Listen to bullish news. Listen to bearish news on Disney. Listen to all of that to come up with the best decision for yourselves. So with that said, let's move over now into the technicals.
All right. So basically, if you look at Disney, I'm actually going to go to what I usually start off with any company. Is it above the moving averages? And you see, you got the red is the 50, green is the 200 daily, and then purple is the 50 weekly. So as of where the price was trending at $96 post market, you're below all of them. But that's not the most significant thing. Remember, when you guys are watching this, if they're on the video, live stream, you see it now, you got to see what the close price is. But to me, the reason the calculator is giving you that value is because you're below the 200 weekly moving average. This company literally from all-time highs to where it is now has fallen roughly 50% to where it's going to be trading at today at 51%.
Oh, wow.
So you already lost 50% of your value, and it's not bad that it traded sideways for so long. It's the spike, right? So it's the spike up and then just falling back to near COVID lows. And to me, it's forming is left shoulder, head, form the right shoulder now. You come up, bounce your head on the 200, and it's just lights out. And that's when you go back to this crazy, or not crazy, this evaluation that is going to like a penny stock. And people don't want to just admit that, but I'm like, look how natural gas is trading.
I don't necessarily going to go to a penny stock. I would argue it's most likely going to fall down to the book value around $50 or so. I kind of see that. But
yeah, and the thing is, like, companies like I've reviewed on Viewer Requested Tickers, probably over 100 companies that have had this pattern. And I always show that when people recommend tickers that what happens when you get above this 200 weekly, the expansion is easy. It's just pure bliss at that point. And you can spend a whole decade trying to get back above this line, and then it becomes valuable. So it's like, go put your money in the index, wait till it gets back above the line, the 200 weekly, and then holds it. Just invest there. It makes life so much simpler.
So, can I ask you a question?
Sure.
So we get the right shoulder. You're telling me that the right shoulder should go up to that yellow line and then just come crashing down?
Yeah. So basically, if you form it, now this is a daily graph. You can, that'll be an insane run. I don't think it forms that. I think it just kind of goes sideways down, because you haven't really been able to break as like a dominant downtrend. If you basically look right here, you kind of broke out of it slightly, but you have a dominant downtrend.
But wouldn't you argue that's consolidating up right there?
Yes, it could be, and which could give you that left push up and then fall back down. But it's one of those things that, like, you're now below all the moving averages. So you spent all this time beating your head into these moving averages, and you finally start getting back above them right here, and you just fall right back down. So I've seen companies where they just, straight down line, and they form a new low, which Disney technically could, at this point. I have to see what the MACD and everything's doing in a second, but it goes back to stop investing in companies that are significantly below the 200 weekly moving average. You spend the next decade beating your head into a wall to just get your money back. It doesn't make sense to me. I've seen too many examples that it's just like, if you're below this, you're bearish, don't invest long. There's more than 1,000 companies out there. If you can't find 5 of them that are above the 200 weekly, I'm sorry, it's just all end times. But there's always better investments. So like, people just get stuck on this I have to buy Disney mentality or insert company here, right? But if we just jump over to Luxago just to see what it's doing, give me the MACD and everything. The MACD isn't necessarily the prettiest thing. I'm actually going to go to the weekly just to clean up the chart a little bit.
Can you zoom in on the MACD?
Yeah. So MACD, we'll do this actually. We'll bring this up a little bit. So you can see that you made it basically a MACD divergence, but you're kind of breaking it because your low's there. So you broke it. You actually broke down on the MACD going sideways, where right here, you should have had a big rip up. You should have had here and you should have had the rip up. Whereas now you theoretically could be saying like, hey, I'm forming a divergence here. Yes, you can make that argument, but I don't think that's a solid argument. To me, if I just look at the weekly, just purely looking at the weekly, this is stagnating. RSI is getting ready to pinch together and head lower. That just looking at the weekly graph, that's what it's telling me. And it's not on top of all the other bearish things in Disney. It's not a good time to invest. And you won't even have on the weekly an intra-week head and shoulders right there. So if Disney breaks, let's say I'm going to say the $90.71, or I'm really going to say this low here, this localized low at $94.07, you're basically going to make a lower low. And to me, you take out the swing point right here, basically $90.46, you kind of are going to self-fulfill. I don't think this area holds of this price action that's here on the weekly, just because it's already been touched and exhausted, and you're pretty much invalidating the inverse head and shoulders that you have on the weekly as well, because you haven't really gone up. So it's basically something you have to keep an eye on to determine which way it's going to go. Now, Disney could open up tomorrow and it could have just buy the whole dip back up. That's where you guys got to do the due diligence. But looking on all of it, if I was a betting man, I basically be betting lower. The daily is MACD as well. If I make this a little bit bigger right here, then you're seeing that it has the potential to curl down. RSI is barely above 50. You have stagnation here on the daily, where basically it's gonna just go basically like nowhere, in my opinion. And you did fill this gap today. You could be coming down lower. It's just everything. I can't find a bullish case to be made for Disney right now. I just see 1 bearish tone, 2 bearish tone, 3 bearish tone. And the other thing, again, I'm going to keep going back to this till I beat the dead horse into everyone's head, is if you're below this line, stop investing in longing companies. It's just there's more companies out there. Prime example, like Chevron, Exxon, AVGO, like all these companies, Pepsi, that are significantly, like Pepsi's above all its moving averages, Chevron's above all, Exxon. Like, why do you want to pound your head for the next decade through all these areas? So you're going to basically pound your head into this sell zone, this one, this massive one up here. You're going to pound your head for probably a month before you get through it. So do I enjoy losing money over the next dang decade to inflation because the stock goes sideways? Like we just covered in the beginning of the stream, the stock going sideways. So it's like,
yes,
I try to make
the stock has actually gone sideways since 2015, roughly since 2015.
So it's like, you lost your money to inflation. You didn't make anything on the stock.
And on top of that, they're issuing shares. And on top of that, they're not issuing a dividend. So you're literally not doing anything.
Yeah, but even here's the thing, like, answer this question, and this is the simplest question. Why do you have to buy Disney? Like, if someone is so hell bent on buying Disney, why do you have to buy it?
I guess
what is so beautiful of it?
I guess just their IPs, right? That's it.
But here's the thing. I don't really care what their IPs are.
Right.
What are they returning to me as an investor?
I get that. But understand that when you do buy into a company, when you buy shares, you're buying more than just a ticker. You're buying a company. So that's the reason why, right? That's the reason why.
But the argument I would be is, okay, I'll go invest in the S&P, and then you go invest in Disney, and let's compare our P&L after a decade.
Fair enough.
So everyone, and I'm not slanting the argument. I do agree with the statement that you're buying more than just the ticker. At the end of the day, it comes down to your P&L. It's your profit and losses, and it's as simple as that.
And also, too, at least this is just from a fundamental perspective. If you're going to own Disney, guys, for the next 30, 40, 50 years, that's not what he's talking about longing, right? That's not what he's talking about longing. Longing is... Do you want to explain what longing means in terms of...
No, you could honestly hold it for that long period of time. But the argument I always make is, if you're going to hold the company for more than a year, that's what I refer to longing. But let's say it's the hypothetical 30 year, right? Why would I spend my money?
That's fair.
Because here's the thing. Why would I spend my money on a company that is below its 200 weekly when there's thousands out there that I could probably find 50 that are above
with a better price as well? Yeah, and with better fundamentals as well.
It goes back to, if Disney falls to book value, the Warren Buffett has shown what happens after 30 years of buying a company at book value.
Yeah,
that's fundamental sense, and at that point it's super undervalued.
And that's the thing as well. Next, for all we know, a year from now, we take a look at their or not a year from now, I would say like 2 years from now, we take a look at their fundamentals again, and we could say, oh my god, their fundamentals are going back up, free cash flow is going back up. We might get a completely different number. But that's the magic of investing, right? That's the art of investing, is that every time you look at it, depending on what's been happening, numbers will change instantly. It's just the way that it is.
And usually once you see that fundamental, usually the technicals pre-run it a little bit, because you see the turning of the company and people kind of getting excited about it. And usually that event that you're describing is going to coincide with breaking that 200 weekly.
Yes.
So it's like, if a company breaks 200 weekly, check its fundamentals. If they look good, it's probably a good buy. Yeah. And you may not get at the bottom, but you avoid the stress. You avoid the I'm going to lose money for a decade situation.
I agree with that. But guys, I think that will pretty much do it for this live stream as well as video. So thank you all so much for watching. At one point, I believe we had 12 people watching. Thank you all so much. And guys, with that said, that pretty much does it. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the New Tech Sites. Link is in the description below. And not any, there weren't any people watching on Rumble, but it's fine. Nonetheless, though, guys, the best way that you guys can help us, if you want to help us, we appreciate the tips. We appreciate that. It's not, thank you so much for that. But at the end of the day, like, subscribe, comment. Great show, guys. Thank you, Self-Prioritized Individual. Love the name. SPI. Absolutely love it. I did see you before, by the way. I know this is not the first time you've been here, but again, thank you so much for watching. Like, subscribe, comment, guys. Thank you to all the lurkers out there. We really do appreciate it. We really, really do. So, 7 likes, guys. Again, thank you so much. Hopefully, one day we could have a daily live stream, right? A daily live stream. Before we actually go, I would actually like to mention something. We appreciate you. Thank you, KO. We definitely appreciate you. Trust me, we do. Here's a quick announcement, though. I am not going to work on Friday. So on Friday, everybody, I am going to try a new format, I guess you could say. So you're gonna get videos from me in the morning, in the afternoon, and then later in the afternoon. All right. So we're gonna do that. I kind of wanted to go try a new format similar to that of Tim Pool, if anybody has ever watched him. Similar to that of him, how he does it. Go over news, then do like 1 or 2 stock analysis, and then that'll be the video. Then around noonish, do the same thing. Go over news, and then cover like 1 or 2 stock analysis, and then at around like 4 o'clock, do another news and do stock analysis. So I think that'd be pretty cool. And yeah, just letting everybody know that that's what's going to happen on Friday. So with that said, guys, peace out, and we'll see you all next time.